Welcome to the LRS's Guide to Financial Reporting, 15 Key Terms to Get You Started. Expanding your practical knowledge of the financial terms corporate companies use will enable you to read annual reports and corporate documents. There are some basic financial terms that every union member should know when they start to deal with the company and its management. Let's start at the beginning. What is an annual financial statement and why do companies publish them? Companies that are listed, for example, on the JSE, are obliged to provide annual financial statements detailing the activities of the business, the expenses and transactions, as well as give investors and the public an oversight of their financial state. Who are the executive and non-executive directors of a company? The executive directors are the leaders at the helm of a company. The executive directors sit on a board with other directors, and together they make decisions on how to run the company. The third important term in our list today is revenue. Revenue is, simply put, the amount of money taken in by the company during this specified time frame. Operating costs or expenses are what a company has to spend to keep itself functioning. It includes expenses like rent, salaries, buying stock, marketing, electricity, and water, all the costs of running a business. The next item on our list is profit. Simply put, profit is revenue minus expenses. If the company made, say, 5,000 Rand in revenue, but it cost 4,500 Rand to run, the company only made a profit of 500 Rand. What does a company mean when it refers to market share? The term reflects the percentage or portion of a market in a specified country that the company holds. Big companies like Shoprite often mention dividends and interest in their financial reporting. Dividends refer to the amount of money paid back to investors as a percentage of their original investment. So what then is interest? If Company X borrows money from the bank, it pays back interest along with the original amount borrowed. Companies have what are called assets. Assets are economic resources. This includes everything the company owns that has monetary value. Anything from office furniture and buildings to unsold products on shelves or trademarks and copyrights the company owns. Just like companies have assets, they also have liabilities. Liabilities are the opposite of assets. This can include loans from the bank or money owed to vendors. Assets are sometimes also referred to as capital. To calculate working capital or equity, the company does the following sum: assets minus liabilities equals working capital or equity. Depreciation of assets is something that happens over time. Let's take the example of an office chair. Company X buys an office chair to the value of 1,000 Rand in 2012. In 2012, Company X can sell this chair for the same approximate value should the company need money. However, by 2019, when the chair is 7 years old, used and out of fashion, Company X can only sell the chair for 300 Rand. This is the depreciation of assets over time. Amortization, on the other hand, refers to debt getting smaller. The term valuation links back to the term we talked about before, assets. When a company is determining its overall worth, it needs to value its assets. How much is the company worth? Often linked to valuation is devaluation, a term similar to depreciation. You'll come across this term typically when referring to currencies. Companies often refer to the term cash flow. Cash flows in from paying customers and flows out again through expenses like rent and accounts payable. It's important for companies to keep track of their cash flow as this determines whether there will be enough money available to pay off any outstanding debts. The term credit is widely used. If Company X is given credit, it means that an entity has allowed them to use money without paying for it immediately. So if Company X is given credit of 1,000 Rand, it means that it has added 1,000 Rand to its list of liabilities. Debit, on the other hand, is when there is an increase in assets or a decrease in liabilities. For example, someone has paid Company X 1,000 Rand for services or goods rendered, and this shows a positive amount in Company X's bank account. You'll often come across the term return on investment or ROI. ROI tries to directly measure the amount of return on a particular investment relative to the investment costs. In order to calculate the ROI, the benefit of the investment is divided by the cost of the investment. So if I invest 1,000 Rand into ShopRite and the ROI is 16.5%, that means I got back 16.5% of the money I put in. The higher this percentage is, the more money the company has made in profit. Thank you so much for listening today. If you have any questions, don't hesitate to contact us or visit our website.